Check, 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 check. Okay. I think we got it. Excellent. Hopefully we'll have less challenges going over this than we've had so far. Let me restart. We're talking about allocation. Talking about capital allocation, I find this is something that is not discussed and can really impact the way that your investment outcomes go. So we're going to look at some examples. We're not going to do a deep dive, although some of you, this may feel like, wow, this is too much. Some of you may think that this is remedial. If that's the case, it's affirming things you already know. That should feel pretty good. But I hope that you'll find something in the next 30 minutes that gives you some way to work towards a better outcome. Fair enough? So let's dive in, shall we? And let's talk about capital allocation. We'll start by talking about risk. Okay, so whenever we allocate towards an investment outcome, risk is something that we need to stay front and foremost. And that is because risk is the only thing we have absolute control over. So whenever you think about investing, and I would say this is a great place to start, is that over the last 25 to 30 years, a lot of investors in the United States have been lulled into this perspective of complacency when it comes to investing. And there are some vulnerabilities to that. For example, in 2008, we had about 23% of Americans had exposure to the stock market. And we know how bad that was. Today, we're pushing 67%. So if we were to have another 2008 type scenario, the impact of that would be exponential and much deeper than what would occur then. So knowing and understanding risk when we think about allocation is a really important concept. And it's something that I think that if we think about that and bring that further to our mind, not only is more possible, but we are also protected from outcomes that we don't want. At the end of the day, as investors, we are paid to warehouse risk that the market doesn't want. So that's how your investment account gains yield, is that risk was transferred to you for a return. So if you want a greater return, greater risk. If you want lesser return, less risk. Now, within those two spectrum or two concepts or facets of that, we can tweak it a little bit, and those tweaks can make quite a difference. So let's jump in. And if you are not up to speed with Miiflo and what we're about, so Miiflo is a investment tech. We're a wrapper that you would pair with or integrate with your own self-directed brokerage account, and it is meant to deliver institutional class investing ideas and help with the risk management. And it's really trying to help remedy the challenge that's facing the next generation or current generation of investors. And what is that challenge? Is that for the first time in American history, the current group of investors is going to do less well than the generations before them. And that bothers me. That bothers me that the current investors are going to do less well. There's a host of reasons around that, about what's driving that. One of the places where we see that is within investment outcomes. So used to be the number that was targeted to get to retirement, in a comfortable retirement would be $1 million. That number then crept to 1.5. It is now 3 million. So the question is, what's the math to get to 3 million in retirement? Okay, so the math, assuming that you would get the current benchmark of the S&P 500, which is 6.7% inflation-adjusted return, is you need to save/invest $23,164 every year for 35 years. And this is at the same time when half of Americans can't come up with $500 for an emergency. If you had an emergency, you would put it on a credit card. That's what people would do. So does it have to be that way? What could we do about it? And it turns out that no, it doesn't have to be that way. We could actually get very different outcomes if we turn two dials. So there's two dials that we could turn that could dramatically impact. So one of those dials is the yield. So if we could do something about that 6.7%, we could do something significant. And then the other is the skill needed to access the playbook that could give you that yield. So let's talk about the yield changes. So if I could give you an investment playbook that could do 15%, you don't need 23,000 a year. You need 3,400. That's a little bit better. But if we could get it to 25%, still get to that 3 million number, but you only need $300 a year, saved/invested. So those playbooks exist. In fact, the barrier to entry to those playbooks is lower than ever. We have to be willing to step into that, and we have to think about allocation as part of that equation. So let's talk about capital allocation specifically within the playbook that most people understand and how that can really impact outcomes. So I have friends that know that I'm in the investing space, that I am a registered professional, and they'll have me take a look at their portfolio. And often what I see when I see a portfolio is I see a portfolio that's 100% allocated, meaning that portfolio is completely exposed to whatever happens. And if you're, specifically if you're in a position where you've been investing for some time and you're not necessarily adding to that investment, what ends up happening when the markets don't go up, as they don't always go up? Again, recognizing that almost every retirement account on the planet is based on the notion that the stock market will continue to go up. So think about that. I mean, what's the potential risk around that? It's there. If you were to, for example, see a 10% drawdown and you're fully allocated, you need 11.1 to get back to break even. But you can see that if you had a 35% drawdown, you need to not recover 35%, you have to recover 53%. If you have a 50% drawdown, you have to have 100% recovery to get back to break even. So the more that you draw down, if you're fully allocated, you're more exposed. And what it does is it creates this cycle where someone, and humans often do this, especially if this could be an individual investment idea, or it could just be a retirement account in general. But we weather these drawdowns rather than leveraging them for what they are. What they are, when you have a correction within the market, that's a buying opportunity. But if you're fully allocated, you can't take advantage of that. Okay? If let's say, for example, that you were not fully allocated. So let's say you had bullets to to allocate, and you were 75% of your cash was in allocation to something, but you had 25% that was on the sidelines. Okay. If you had a 20% drawdown and you were fully allocated, you need a 25% recovery just to get back to break even. If you pull back 20% and you allocate that other 25%, you change your cost basis, and then now you just need 17.7% to get back. So if you have bullets to spare for these opportune times, when we don't often get them. We don't often get these opportunities to buy at a pullback. But if you've got bullets on the sidelines, it can impact, one, the ability to recover. What happens if you can't recover? Typically, people will say, well, it's no big deal because you have X period of time, except when that timing matters. For example, this is anecdotal, but like my father-in-law had to delay retirement by 5 years because of 08 and 09. He was exposed enough that pullback meant that he had to stay longer to get back to the same outcome. So thinking in terms of always having something available can allow you to take advantage of other opportunities. It can also help you recover if you have something that doesn't work. So if you wanted to go for a more aggressive retirement yield, as opposed to the 6.7% that is just available within the market in a very passive way. So let's say you wanted to be in a playbook that could allow you to get a better yield than that, which they exist. That playbook is most accessible via something called multi-leg option strategies. So what exactly does that look like? So this is the Miiflo dashboard. All of these are investing strategies using options on stocks that people know that are built over a certain period of time. Now, these have windows of about 20 to 40 days to be realized, But let's just look at, for example, this gold. Gold's been in the news recently. This is using 4 option contracts. Sorry, guys. Got a little frog in my throat here. I did a bike race last night, and I've still got some dust in my lungs. You got 4 option contracts here that are using the gold ETF. Now, the return on capital of this position is 21%, is the target return. That's 21% in 20 days, as opposed to 6.7% over a year. And this actually has a probability to it when you apply it. However, a probability is not a guarantee. So part of having bullets on the sidelines, if you want to get a yield that can do better than a 6.7%, you're going to need to have bullets on the sidelines for when ideas don't work. Because this can help you recover. It means that you don't have to completely take a hit. You can recover from those. If you're fully allocated to ideas, and I've had friends that have gone in on this incredible idea that they was a sure bet, which again there's no sure bets, but they believe it was a sure bet. So then what ends up happening is that if that craters, there's no recovery, because there's no way to either express an idea that could actually work or to move that into something else. So when you're thinking about allocation, having bullets to allocate is a huge, huge, huge thing. Now, let's talk about if you're in the traditional playbook of where most people are with an S&P 500 type scenario. Okay, and let's talk about the S&P 500 real quick and the idea of passive investing as it pertains to equity markets. I mentioned that in 2008, about 23% of Americans had exposure. It's now 67%. It's getting closer to 75% all the time. What's at play in that is that over the last 25 to 30 years, we have had a move toward deputizing pension risk to the stock market. There used to be companies that would pay pensions to employees, and then let's say, for example, a company like General Motors here in the United States, they find out that they're actually paying more to people who are retired than people who are actually working for them that are generating the profits to pay the people that are retired. And so the ideas of IRAs and 401ks and tax-deferred savings accounts, such like that, were birthed to offset that risk. Okay, so we are more and more moving more retirement exposure to the market. Now, that can be very encouraging in the fact that there's more people in that boat. There's more reason for the powers that be to step in and support that, which is what we call a passive bid that is in those markets. There's flows that come in that buy in pension funds throughout the year. That's why there's, it doesn't really work to be bearish on the stock market, except for a few kind of challenging times. And again, those are times to make sure that you have stuff on the sidelines. But there are also rhythms throughout the year that you can leverage. So let's say, for example, that you were going to leverage that classic playbook, and let's talk about some wins, like when to allocate. Okay, so here's one, and these would be places that you could allocate if you have cash available. Is to wait for a 10 to 15% pullback. We on average see at least one, if not two, 10% pullbacks from the all-time high in the S&P every year. Okay, have bullets for those times when that happens. Also, there are specific windows that are very advantageous to buy where you're more likely to get the index at a discount. One of those is from March 15th to June 20th. Okay, March 15th to June 20th. And then the second one is September 20th to October 31st. These are historically the weakest periods of time in the U.S. equity markets. Why is this? Well, one is that we live in a world where more and more the tail wags the dog. What do I mean by that? It means that underlying assets are driven by their derivatives. What's a derivative? A derivative is a vehicle that takes its price from something else. So options, like what Miiflo uses, option spreads specifically, are based around the idea that that pricing is built around some other product. So gold GLD is an ETF. I can build an idea around that, this derivative pricing from that. Those derivatives, what's fascinating about it, there's such high volume in that, and it's increasing every day. Because of that, there are windows when those derivatives expire, and that opens a degree of volatility and uncertainty in these specific windows. And these are the windows when we start to see the best chance for lower prices. So if I'm going to allocate, I'm not going to allocate immediately in January at the beginning of the year. A lot of people do that. They'll come in and they'll do their maximum Roth IRA contribution at the beginning of the year, and then they'll fully allocate that to the market. If they could wait and do that during one of these windows, you can see about 2% additional per year over a 20-year average, just changing the window. Okay, so you could still deposit it in the account, get the tax benefit, but delay the allocation to when one of these events happens. That could give you an additional 2%. So rather than 6.7%, you could be looking at 8.7% inflation-adjusted return over 20 years. Okay. The other one, and this is a little bit more technical, but it's what we call a VIX curve reversion. What's a VIX curve reversion? So if you're not used to looking at charts, not a requirement, but I'm going to show you something that may change your world. Okay, so this is a chart of the S&P 500. So we have the S&P 500 up at the top. These are daily candles. What is a candle? It's the open, high, low, close of that session. Down below, we have a number of lines that have VIX in front of them. So what's VIX? VIX is the volatility index. Now, this can make you interesting at parties. If someone says something about when the VIX is at a certain price. So currently right now, the VIX is at 1975 is the price of that index. They'll say when the VIX is at this price, I do X. That used to work about 5 years ago. That may have held water. What we've seen more and more is that the participation of market participants in these derivative products is going to shorter and shorter durations. In fact, greater than 65% of all volume in derivatives in the S&P every day is in options that expire in 1 day, which is what this 1D index tracks. Now you'll notice that there are these pinch points, these points where it looks like the 1D goes up to match the longer duration. So you have 1D, this is 1 year. So that would be options that are built as hedges that are year out versus those that are 1 day. Normally, in almost all situations, or normally, as you can see normally, the price to hedge something for 1 day versus the price to hedge it for a year is much cheaper. That makes sense, right? Let's say that I lived in an area that was prone to hurricanes, and there's a hurricane season. I'm going to buy at a insurance policy that's at the beginning of the season versus one that would just cover me like the last week. Theoretically, the last week one would be less expensive because I could probably look out in the Atlantic and see if there were any hurricanes, as opposed to a full season when I don't know how many hurricanes that I would need to protect against. So that is the normal curve. However, there are these periods where we get so fearful within 1 day, we're paying as much for 1 day protection as we are for a full year out. And that is what we'd call an inversion in the curve. And the combination of these indexes is what we see down here. When you see, for example, this yellow line goes above 0, that's what we would call a reversion. So that you can see the pinch here and then the expression of this. How does that happen? What basically happens is that market participants pay too much for a hedge, and for markets to go lower, you actually need people to keep buying hedges. Well, if the hedges get too expensive, they stop. And that effectively puts the brakes on the market. So when you see these pinches, that's a spot where everybody who's really concerned is concerned. And so if nobody else comes in with concern, that puts the brakes. When that reverts, you can see that leads to higher prices. So here's a reversion, higher prices. Here's a reversion back here, and that led to higher prices. So when we see an inversion is where the short term gets above the longer term, and these are pretty narrow. Let's go back to some bigger ones. Let's go back to April when we had the tariff liberation day. Okay, they can get pretty nasty. The bigger the inversion reversion, the longer the move to work this way out. So when these revert, when it goes back to normal, those are buy spots as well. So that's the final, and this is actually the most predictive win when it comes to when you allocate, is you allocate on a reversion of that curve, a reversion of these products. As these things are, essentially what happens is someone pays for protection and they don't realize any benefit from it. And so those products expire worthless. The expiration of those products causes a chain reaction, and that's what actually leads markets back higher. Okay, so like right now, we're at pretty normal, what I'd call a normal area, meaning that we're not at risk, or we're not in a spot that I'm actually looking instead for another one of these types of environments, which would lead to lower prices. And then once that reverts, that would give us the next buy. Okay, so those are the wins of when I would allocate. So either a 10 to 15% pullback, which by the way, if you get a 10 to 15% pullback, you're going to see some VIX reversion. So if you don't want to track that, you don't have to. Just know, hey, from the high to the pullback, that I'm likely in one of those spots. These two periods of the year are important, and then know that it's kind of tied to the first one. But you get those are the wins of when to allocate. Okay. Let's also talk about allocating according to plan. There is so much of the way that I see investors allocating that really is just based on assumptions, but not really something that may lead to a benefit. So let's talk about one plan, and this is the low hanging fruit in terms of allocation, and that would be dollar cost averaging into an index ETF. So what's an index ETF? So the SPY, which tracks the SPX, or the QQQ, which tracks the INDX. Okay, these are exchange traded funds that you can buy with very, very low fees that track the indexes. Now, dollar cost averaging, if you were on a program where you had a set number of allocation that you were going to do through a year and you buy every month. So this is buying every month. You are buying these some degree of these indexes. That helps ensure that you're buying at all prices, which will include those pullbacks. What you don't want is you don't want to always be buying at the local highs. You want to be able to leverage and keep lowering your cost basis, and that's what a dollar cost averaging program does. So if you're not in some type of dollar cost averaging program, that is the most reliable way to grow assets. 6.7%, it's not a great yield, but it is a yield. It is warehouse to you. This is a great way to do that. That is the least amount of risk. And if we get pullbacks and you are on that program where you'll continue to allocate, you can lower your cost basis and not miss out on the growth. Another way to allocate is based on 4 questions. So let's say that you want to step out and do something a little bit more risky so that you could get a better yield. There's 4 questions that I ask/answer before I enter. If I don't have answers to these 4 questions, I don't enter. And that is, 1, what is the opportunity or the target? So, as recently, I'm getting texts from friends like, I want to buy silver, I want to buy gold, I want to buy Bitcoin, because I'm hearing people talk about, like Ray Dalio was talking about, I need to buy these things. The problem is that no one's defining a target. Okay, and when no one is defining a target, this kind of stuff happens. All right. So let's look at here. We're at 4,400 in gold. No doubt somebody was trying to buy that thinking they're missing out, and we have 5% pullback in one day because it just got too frothy. So if you're just chasing it based on, I'm hearing all this noise and I need to be in this thing, that's not going to get you the outcomes. So building it based around some target or reasonable hypothesis of what's going to happen or where it's going to go. Now, if you bought it because you believe that gold was going to go to $6,000 an ounce, and you said, hey, I'm okay to buy anywhere from here down to 3,400 to get to 6,000, then no sweat, right? Who cares if you bought it at 4,400? It's within your risk window. But thinking that way, I over and over and over again come across most often friends who know that I'm in markets, and they'll say, well, hey, the other day, a friend of mine sent me a picture of a stock that he had purchased. And I was like, I don't even know what the stock is. And he's like, oh, it's going to, this thing's going higher. Okay, to where? I don't know. He had been in the stock for 4 years and had been underwater. It just got back to break even. I mean, fine that he's still holding it, but the opportunity cost of holding something when you don't know where the opportunity is to know that something's not working is huge. Okay, so it's a poor allocation of capital. So if I first start by going, what is the opportunity of the target? Then I can say, well, what am I willing to risk to get that opportunity or target? That's really, really helpful. And most of us use these types of skills in other parts of our life. You may buy a house, or you might, you wouldn't do this because it's a depreciating item, but let's assume that you buy a car. You might say, well, what's the resale value of that? And you're thinking through the depreciation, because you're thinking about through the depreciation because it's a depreciating asset. And I'm an advocate for not buying depreciating assets. But what would I be willing to risk? What would tell me that I'm right? We are all storytellers whenever we invest. So how should that go? That can help us know that we are on the right path. What would tell us that we're wrong? That's almost more important, because if we know that we're wrong or something wasn't supposed to happen, we can get out and we can reuse and reallocate that capital to something else. Because if I'm allocated into something that is not working, I'm stuck. And I'm not just not realizing the appreciation of that, I'm also now accruing opportunity cost because there's something else I'm not in that could be bringing me yield. Okay, so this brings me now to the idea of capital allocation according to probability. Now, from a passive investment, we already talked about, like, the most probable way to do that is just buying an index ETF. It's the least fees. You have the full weight of the Federal Reserve and U.S. policymakers behind to ensure that that doesn't fall or fall for very long. Last time we had that in COVID, what happened? There was $6 trillion of stimulus that came in to make sure that people would buy stocks and keep those higher. So certainly that's the most probable, but also having a way to allocate probabilistically when stocks don't go up. So if we were to go back to the Miiflo platform here. So let's look at all of these ideas that are generated for today. When you do multi-leg options, these are all, so any of these that are iron condors, let's look at the iron condors, for example. All of these ideas are built on the idea and expectation that that stock or that ETF is not going higher or lower, it's going sideways. So these actually gain by a stock going sideways. Wasn't that interesting? That provides a whole different way to approach. In fact, if I just isolate by credit drips, so these are all based on the idea that a stock has lost its mojo. An iron condor, it's going to be in a wider range. Iron butterfly, it's going to be in a tighter range. But essentially they've lost their directional mojo. If you are in the classic investing playbook, you don't have anything to do. You just have to kind of weather these. You're sitting. This allows you to benefit. These also, by the way, are probable. What does that mean? When you buy a stock, for example, it's a 50-50 bet. It's a 50-50 bet. When you enter an iron condor, for example, there's an 80% probability of profit. 80%. Now, again, these are not guarantees. But if I was going to allocate, I would allocate higher to something that's more probable within the mix. In fact, within our platform, we actually have a little wheel to help with allocation. So we say, okay, I want to have about 25% of capital available. I've got a little bit more than that. I've got 38, so I could allocate more. On the credit side, I want to be between 40 and 70%. So I'm right in the sweet spot there in terms of current ideas that I'm allocated into. So I can look at current ideas I'm allocated into. And then the debits, so this is a different type. So let's go back to the flow here and let's look at debit drip types. So these are ones that are built more either directionally or they're expecting direction. There's a lower probability, but notice the asymmetric reward to risk. So like, for example, this butterfly in Salesforce, I'm going to pay $260, but the max profit is $1240. So if you're gonna allocate based on probability, allocate smaller amounts to the things that could get a bigger pop. Allocate a larger chunk to something that is more likely to pay you. What that ends up giving you is it gives you a mix of good, consistent asset growth, and then it puts you in position for these pops that don't happen as often, but when they do, great. It's giving you a little bit of the best of both worlds. So when you're allocating according to probability, make sure that you're thinking through what is the probability of this thing. If it doesn't have a probability or it's just 50-50, how can I find something that is more probable in the way that I allocate? Okay? So that, my friends, are my thoughts when it comes to how do we allocate capital, various ways of how allocation can radically change some of the outcomes. Again, pretty light approach to that. So again, some of it you may be like, yep, I'm up to speed with that. That's great. Other parts of that may be new, and it's, what do you do next as you go and explore that? If you would like to explore that within the Miiflo ecosystem, you can always do that. You can get started for free, and for a free month, you can play with the drips and play with allocation and see how that impacts the outcomes. We actually, it'll give you feedback on where you need to allocate according to, to our probabilistic model. Our probabilistic model is not the end all be all, but it's a model that can put you in the seat to see 20-25% a year, and that can radically change someone's outcome. So I hope that's helpful. We'll do another flow session in a couple weeks. In the meantime, be thinking about your allocation, and I hope all the best for your investing outcomes. And we'll talk to you again soon. All right. Cheers.